All right. Well, we'll get rolling. I'd like to thank all of you for joining us this evening, and and it's great to see some familiar faces from our previous webinars. And yeah, we do have some new faces too. So thank you guys. All of our webinars that we've done so far have been recorded, and we can definitely get those out to you to watch if you haven't seen those. If you have questions during our presentation, feel free to enter them into the Q&A, and we will definitely get to them at the end. And as always, if you have questions later on after this, feel free to reach out to us. Our goal is to keep this extremely high level. We will be getting a little bit into the weeds, but we're going to try to keep it at that 30,000 foot view and talk about the basics of underwriting for limited partner investors and what to look for when you're considering investing into a syndication as an LP. This presentation ended up getting so large that we broke it into two parts. We thought it'd just be easier to do it in two parts and still be able to cover the content, but not drag this on for an extended period of time. So with that, yeah, let's roll into the introductions. First, just myself, Mike Strodman. I live in northern Minnesota, a town called Bemidji, with Blue Skies Equity. And I have a master's degree in urban and regional studies. Previously, I was a city planner and did all aspects of planning and zoning. I've always enjoyed real estate. I've always had a passion for it in looking at buildings, seeing where they're going, if it's commercial or residential. We've bought everything from items that needed to be and had heavy renovations inside, outside, all the way top to bottom, to stuff that was ready to go. Virtually just maybe a little bit of carpet, maybe a little bit of paint, and mainly buying these properties that were that their rents were under market. So seeing the value in that, having landlords that have owned these properties for a significant amount of time, comfortable with it, with the cash flow that they're receiving, love to just have long-term tenants, didn't want to rock the boat. But we were able to come in and buy those and then increase the rents to what the market was. We've also done some ground up construction, bought and subdivided some land. And presently, we're the owner and operator of properties here in Minnesota. We're also a limited partner. Total unit count is north of 600 residential units. But with that, I'll turn it over to Brandon.
Yeah, thanks, Mike. My name is Brandon Gattay. So for those of you that haven't been on our webinars before, I am with By Design Capital, and we're in Rapid City, South Dakota. So still in the upper Midwest, like Mike, but on the far west end of the state here in South Dakota. Again, like Mike, my background is not in real estate. I started my professional career a little over 10 years ago in the engineering and construction space. So I have a degree in geotechnical or soils engineering, and I also have a degree in construction management. Most of that professional career, the last 10 years or so, really has been on that construction and really on the project management side. Started a long time ago as a project manager, moved into senior PM roles, and then into director and executive leadership roles within those construction companies, leading teams, leading business units, and really getting to know the ins and outs of the business side of things, managing P&Ls, really looking at the strategic planning, looking at 5-year planning, things like that, up to $40 million a year operating budgets in a $500 million a year company. Is really where I landed at the top of my career. And really through that, I started to see the synergies between what I was doing on the business side and where I was starting to get into real estate investing. At the end of the day, and we'll talk a lot about it tonight when we're talking about the financials, these really are little businesses that we're looking to acquire and operate. So managing P&Ls and really looking at building those business plans, it really just overlapped. So decided to jump into this full time about a year ago. But I have been investing in real estate for over 5 years now, getting close to 6. And started like most folks in the single family space. I did some short-term rentals, quite a bit of private lending. I still do private lending. Some experience with that and through my self-directed IRA and some private funds. And then in the last couple of years, as I started to see the challenges with scaling a rental portfolio, especially locally in a smaller market, I really started to get into the multifamily space and the commercial space almost exclusively in the last couple years, and then going active in the last little over a year ago now. Present portfolio, right around 300 units. Majority of those, almost entirely, is multifamily. Now getting rid of the last of my single family long-term hold portfolio, and a good majority of those has been through LP investments. So I do sit on both the active and the passive side, but the majority of my commercial experience is on that LP side. So I bring a lot of that perspective, especially on the numbers side. I do have a background in engineering, so the technical side in me, I'm the numbers guy. So I definitely tend to get into the weeds on these, but definitely bring that perspective from the LP side.
As always, we just want to throw up the quick disclaimer. The information that we'll be showing tonight, just informational purposes only. We're not CPAs, we're not attorneys, so definitely, seek professional advice if you're going to invest in real estate or anything else.
Yeah, absolutely. So we'll jump in here and we're going to start, like Mike said, very high level. What is underwriting? You hear that term thrown around. You've probably heard it maybe when you purchased your own home, loan underwriters, those types of things. All of it really boils down to business planning, building a plan. It's really what underwriting is. If you've been on our prior webinars, we like our quotes. We like to kick things off with quotes. So I really like this one from Benjamin Franklin. It says, if you fail to plan, you're planning to fail. And again, that's really what underwriting is. You're going through, you're reviewing the existing financials of that property, the existing operations and the condition, identifying areas where you can improve that, either through increases in revenue, decreases in expenses, renovations, changing management, any of those types of things to really improve the property. And again, building out that business plan. And then through that business plan, projecting what those future financials and returns might be. From there, you really take that, and that's what you determine what the value of that property or that asset is to you to hit those target returns for your investors, for yourself, as you execute those business plans. And perhaps more importantly than any of that is, as you build that business plan and set those targets, those are really the KPIs, or the key performance indicators that you'll be monitoring. The operators or the sponsors will be monitoring, and yourself even as an LP, to ensure that you're on track to that business plan throughout the life of that investment. And more importantly, if you're not on track, you need to know that. You need to know it early, so that you can pivot and make those adjustments to make sure that you're staying on track. So that's really, again, underwriting is really just building a business plan, especially in what we're talking about with acquiring these types of assets.
Yeah, those KPIs are so important. All the way through the process, you're constantly monitoring that from purchase and operating. That property. Definitely when you're looking at the asset management side of things, and all the way through the sale. So no, they're important.
And probably so this is probably the most boring slide, but I think it's important. When you're looking at potentially investing in deals or looking at some of these OMs, we tend to throw out a lot of different key terms and different lingo, different acronyms. So there's a lot going out there. So we wanted to touch on some of these to make sure that everybody has a good understanding of what we're talking about as we go through this, and as we're presenting deals, or as you're looking at deals. So on the purchase and finance side, some of the terms you'll hear: whisper and strike price. Typically, that's the price that is what the broker put together, or what the seller is hoping to get what they're taking to market. Very often, at times almost exclusively in the last year or so, our offer prices are not at the whisper or strike price. So that's the difference there. Is those are what they bring to market. Doesn't mean that that's what we're going to pay. LTV, or loan to value, that's fairly straightforward. One of the ones that's out there that's really important is debt service coverage ratio, or you'll hear that as DSCR. And that's the property's ability to service the debt, to pay those mortgage payments through the operations of the property. So of all the positive cash flow that comes from income minus their expenses, how much of that can cover the debt? If you're at a 1.0 debt service coverage ratio, that means that the income minus expenses just covers the debt, and that's it. If you're over 1, that means you cover more than the debt, so there's actually some cash flow and some profit. If it's less than 1, that means that the operations are not covering the debt. So that's a really important metric to understand. Interest only, or IO, is what you'll see a lot of times. That just means that the loan has a set period, a few years potentially, where all you're paying is the interest and none of the principal, only paying those interest payments. Variable versus fixed interest rate, those are self-explanatory, very important right now. Then value add versus stabilized. Value add is what we'd like to look at. And that's where we can come in through improvements of either operations or renovations, raise rents, and improve the value of the property. Whereas stabilized means it's at market, it's at a good solid market occupancy, and it's operating where you want it to as a part of that business plan. On the income and expense side, gross potential rent, or you'll see that as GPR, that means what is the maximum potential rent that you can get for that property at a market rate, not including vacancy or any of the other losses that we'll talk about. So at market rates, what's the most you could get if it was fully occupied and everybody's paying? Then you have some of these losses, general or physical vacancy. This is just how many are leased versus how many units there are there. Whereas economic vacancy, which you're hearing is a very important term, is what are you actually collecting income-wise versus that gross potential rent. So that economic vacancy includes things like bad debt, which is just people who aren't paying, loss to lease, which is the delta from what you are charging for rent versus what the market rent rates are. And then concessions, we're starting to see more of these. These haven't been common in the last few years, but concessions are free first month or second month rent. We'll give you a big screen TV, discounts on rent. Those are concessions. So that economic vacancy takes into account the physical vacancy and all those other income losses. Some of the other ones you hear common, RUBS, or ratio utility billing. This is where the owners or the landlords can bill back some of the utilities, commonly water, sewer, electricity, gas, back to the tenants. If the owners or the landlords are the ones paying those, you can bill those back. You'll hear the term T12, T3. These are trailing financials. So T12 is the last 12 months of income expenses. T3 would be the last 3 months. So you'll hear those terms. Then operating expense ratio, or OER, that's just the ratio of expenses to income. So if your income is $50,000 or $100,000 and your expenses are $50,000, that's an expense ratio of 50%, which is a common baseline that we look for, is that 50%. And then lastly, net operating income, or NOI, and that is just income minus expenses. So what is the operating income of the property, not including debt? So that NOI does not include what you're paying for the mortgage. So those are some of the bigger terms. There's a lot more out there, but those are some of the important ones that we see get missed often.
We definitely have plenty of stories in regards to all these, but kind of the last one that really showed up was that Brandon and I submitted an LOI on a property, and we looked at the operating expense ratio, and it was at 68%. So that gave us an opportunity to kind of look at it and be like, what is going on here? Is there ability to get that near that normal range, that 45 to 55%? Some instances we can, other instances we just can't, because maybe it's repairs and maintenance due to the age of the building. It's the taxes in that area, whatever they might be, that can throw that expense ratio out of whack. But whenever we see a high expense ratio, it definitely gives us the opportunity to dig in a little bit deeper to see if there's a way for us to decrease those expenses.
Yeah. All right. So for the fun slide, the return metrics. So this is how we get paid as limited partners and investors in general, whether it's in real estate or not. These are common terms that you'll hear. And certainly some of the metrics that we are targeting when we're pricing out our property. So this table, there's kind of a lot going on. We won't go word for word through it, but really the intent of this table and why I like it is it breaks down each of the return metrics by what the inputs are and really what they each mean and what they're taking into account, because each one tells you a little bit different of a story. So that cash on cash return is really just based on cash flow from operations. That doesn't take into account cash from capital events, which is a sale or a refinance. And it doesn't take into account the return of your capital. So if you invest X dollars, this does not take into account that return of capital in that calculation, purely from cash flow. And when you look at the average cash flow, it does take into account time. So it's just cash flow divided by investment over the number of years. If you're looking at a single year and say you get $10,000 in return and you invested $100,000, that's a 10% cash on cash return for that year. Average annual return is fairly similar, but it does take into account cash from capital events. So it does take into account if you were to sell the property, that larger windfall towards the end of the investment horizon, it does take that into account. So cash flow plus the capital event divided by the time horizon is that average annual return. One of the most common ones, this internal rate of return, or IRR, is a very complicated formula. As you can see here, I'm not going to pretend or even try to go through and explain that formula, but really the intent of the IRR is it takes into account everything. That's why it's so popular. It takes into account your cash flows, capital events, the return of your capital, and the time value of money. Not just the time horizon, the 5 years, 7 years, 3 years, what have you. The time value of money is taken into account there too. So this is a really common metric that's out there that helps you compare this versus other investments, being similar real estate investments, what have you, gold, businesses, stocks. This helps normalize across different investment types. And then lastly, this equity multiple, this is probably the easiest one to calculate. It takes into account the cash flows, just the cash portions, but it doesn't take into account time. So really what this says is if you invest $100,000 and over the life of the investment, you get $200,000 back, including your initial investment, that's a 2 equity multiple. You doubled your money over that time horizon. But again, it doesn't take into account the time piece. So that could, an equity multiple of 2 in a 1-year investment, that could be great. Doubled your money in 1 year. If that investment horizon is 10 years, maybe not so great, but it's still the same multiple, just 2. So it doesn't take into account time. So I really like this table. It really helps tell you what each of those is really intending to show you on how your money is working for you.
Yeah, it definitely does lay them all out. And, when you see a pitch deck of a property and from a sponsor team that's going to buy one, a lot of times they'll lay these out. Sometimes they'll have them all. Sometimes you'll see a variation of these. And like he said, like Brandon mentioned, they do all measure a different thing. So it's not that you need to know how they're all set up, but just kind of how they all may work. And they may work together or separately, depending upon the length of time that you're buying, holding, in all the other situations that are presented with that. So not that all of them will always be there, but you'll typically see 2 or 3 of these each time.
Yeah. And how they tie into your investment strategy too, where if there's a high IRR and a low cash on cash, that's probably a value add play where there may be not a lot of cash flow, but you're really looking for that end investment at the end of the business plan. Whereas if you're looking more for cash flow, you may be okay with a smaller IRR if that cash on cash is higher. It really ties to really what the business plan is and what your investment goals are.
Yeah, definitely. Good point. Just kind of our underwriting process, initially we do we do that quick review where we want to just high level, how is this property doing? Where is it at? Look at the offering memorandum and just make sure that it fits our buy box before we start spending a lot of time and energy looking at it. If it passes there, we'll go to step 2, which is our market review. And again, we'll do an analysis of the location. We'll look at the demographics. and also the financial analysis, that early review. But then we'll get into the detailed analysis in step 3 of that asset, and we'll look at the rents. We'll develop our pro forma based on our business plan and determine, where we can improve operations on that property. If we get through that and everything is still looking good, then we get to step 4, and we're going to determine our offer price. And based on the outcome of our analysis, we determine the offer price needed to produce the target returns that we want, for us and the investors. So as you mentioned earlier, we'll see the strike price, but how close to that can we get? And if we feel that it's in line, we'll run this all the way through the process and submit an LOI to see if we can purchase that property. But here we'll dive into this just a little bit deeper on each of the steps. So first, again, we have the initial review. Does this meet our criteria? We'll check to ensure the asset meets the criteria for its, look at the age, the size, the class, the location. Is there a value add, or is it a stabilized property? So that we can, clearly define a business plan or think of a business plan that may work for that property. We'll definitely look at what amenities it has. Is there a pool, a gym, a clubhouse, washer, dryer hookups, a laundry facility? And again, this can change property to property, asset class, because again, for a Class A property, and it's, maybe in the southern part of the U.S., they're going to probably want a pool and a clubhouse, and washer dryer hookups. That is an area where if it has washer dryer hookups, we've got the ability to either allow them to bring in units, we could rent them units. Either which way, we know we can command a little bit higher rent for those units. We'll also look at the floor plans. The age of the building can oftentimes let us know what that floor plan is going to look like. If it's old and boxed, there's not a lot of open space. And just want to see what those layouts are to make sure that what tenants are looking for today, that it is within line of that. You also look at the different layouts for kitchens. How many different plans are there for those? If we're going to do a major renovation, we want to make sure that we don't have a ton of different ones where we need to go in and measure and set up a separate order for each of those. It's nice if it's 100 units, maybe there's two different layouts, or even if it's 3, but we can set it up so we know we need, X number of layout A, X number of unit or layout B. So keeps that simple. In this step, we're also going to look at the high level CapEx stuff. Again, we haven't gone there, we haven't dove in, but just high level, what can we gather from the OM that talks about what might be needed there, or what has already been done there? We can look at, Google Earth and check out the parking lot. Is it really beaten up and going to need total redo? Maybe it just needs to be striped or resealed. But we can look at that along with the roofs. If you can find areas of a roof where there may have been some shingles that have blown off, you can see that color variation of them shingles to know, if there's going to be some additional expense, looking at large CapEx in regards to that roof repair or total replacement. And then looking at the basic operational information, again, we're going to, look at the operations of it. We're going to look at the financial information that's been provided, and look at vacancy. What is their vacancy rate? What's the vacancy rate for that market? We'll definitely look at the T12, the trailing 12 months, and also the pro forma cap rates. But the picture on the right, definitely gives us a good sign. This is where it's we're going to go forward or it's a no-go.
And I would argue that this may be the most important no-go through the whole thing. Throughout the process, they're all stage gates. So we are checking and say, okay, are we going to move to the next step? And the real reason behind that is it's not easy to find a good deal that meets all the requirements and will hit those return metrics. So we have to look at a lot of deals, and we don't want to just be looking at anything and everything. We want to make sure that we're able to spend our time where it matters, and that's really on the deep analysis. So we want to make sure we say no quickly to ones that don't meet the criteria, doesn't meet our buy box, and we can sift through quite a few of these really quickly at this stage, just to make sure we're spending that time where it really matters.
Definitely. If you joined us last time, we hit the market analysis and review of that really hard. We dove in extremely deep as to what we look at. But here again is where we're gonna look at the demographics and the population growth, poverty rate, crime rate. What type of market is this, and then also to go to that neighborhood level and really see what's happening at that level. We're going to look at the employment and income. Is there job growth going on? What is the unemployment rate and the median income? Because we want to make sure, and it kind of goes down to that affordability side. We want to make sure that our rents are within line of what the residents in that area are making, and what are the median home values, and others charging for rent, in that area. Those are all very important numbers for us to compare our project against others in that market. When we look at housing supply, is there a lot of supply coming on board? And what is that absorption rate? You can look at some of these markets where they're adding, thousands upon thousands of units a year, maybe tens of thousands, but they're being absorbed very fast because of the population growth that is happening in that market. But we also want to see what that vacancy rate is for that area. If their vacancy rate is low, that and it's follows that through a lot of the same buildings and asset classes within our area, we know that it's going to be a decent market to buy in. If the vacancy rate is higher, it's definitely going to raise a red flag to figure out what the issue is.
Yeah, and I think really quick on the market piece, that whether it's us looking at deals or anyone as an LP, really validating with your sponsors and checking into it yourself, not just the overall market. Say we're looking at somewhere like Denver that's larger, or even where I'm at in Rapid City. You want to understand not just the overall market demographics and the trends. You want to understand at a sub-market level, neighborhood level. I think we've all been maybe where you live or to other cities where one side of the tracks is great, other side of the tracks not so great. And that's really important with these properties, where if you're comparing and showing great employment growth, job growth, great wages in one area, but the area that the asset is not the case, then you're not going to have renters. So really important that you validate that, check with your sponsors, and make sure that they're looking at it from a sub-market level and not just saying Denver is growing at X rate. Look at this specific sub-market neighborhood. Is that area growing? Is that a great place to invest?
Definitely. Great point. Here's kind of where we'll look at those gross potential rent. And, step 3 is that financial analysis and diving in deep there. We want to review the T3 income, and that is, again, your prior 3 months. So we want to dive in and see what their income is. We also want to see what other options there are to increase these rents. Mentioned earlier, Rob's, and again, the easiest example there is sewer and water. An ability to build that back on your residents. You need to make sure that is something that's common in that market. If it's something that isn't, and it becomes a new fee for the tenants, you may end up with a little bit of vacancy from that. But if it's something that's common and it's become very common, you definitely utilize that. We look at parking spaces. There's a few different ways of doing that. You can set up reserved spaces where people would prefer and want to not have that park at will, but be able to know that this is my parking space and it's a reserved in front of their unit or whatever it might be. That can definitely command additional fees for that, and people are more than happy to have that. We look at parking We can also look at garages, and where we are at in northern Minnesota, and in other areas in the Midwest. You have the want for garages, so they're not having to brush the snow off the car, get the frost off the car, etc., and willing to pay for that garage space. Down south, where they have more issues with the sun, people are willing to do like covered parking, and it's a great way there too to increase your net operating income by providing that amenity. What we try to do there is look at what is it going to cost to build it, and can we recoup that money within 4 years? 3 years is great, but 4 years is kind of that cutoff where it makes sense or not. Bulk cable and Wi-Fi services is another one that we see frequently, where a company will provide services to the building, and maybe they charge you $30 a unit, and they just want to bill you. They don't want to have to collect and try to get the contracts with all the different tenants. So they'll just do a flat bill, but you're going to pay that on all your units. And then you can rent or provide that internet service to the tenant. And usually what you can do is you increase it, because they'll provide you a really good deal up front, say $30 a unit. What you can do is charge 50 or 60 bucks, which is probably significantly less than what the competitors are, and your tenants would obviously enjoy that cost savings, and you can also make up on that delta too. So just another way of increasing the NOI. We also want to ensure that the income losses are accurately reflected. And this goes right back over to the right side here, where we look at the gross potential rent, because the physical vacancy, which is, the units that are empty, you've got to make sure that's reflected. The bad debt, who's not paying and you're waiting to get them out. Concessions, if you're offering concessions, there again, that's a loss of rent. And then loss to lease, where let's say when you bought the property, they were at 900, the market is 1,000, or you're doing a rehab and you're able to get it up to 1,000. Until you get it there, that is your loss to lease. So we want to make sure that we're able to see what those losses are today, until we can get it to that full gross potential rent, and hit that economic occupancy between that 90 to 92%.
Yeah, and I think one thing to note, and really for anyone that's looking at a potential investment opportunity, is one, like Mike said, make sure that these are all accounted for, but also make sure that the timeline to get to that economic occupancy is realistic. And what I mean by that is if you're looking at a property that's a value add, especially where maybe there's high vacancy or there's a high loss to lease, it takes some time to get better tenants in, do the rehabs, get things up to market rents. So if you're saying that you're going to be able, or the operator and sponsor are saying they'll be able to get there in a year, but you're jumping from 15% vacancy to 5% vacancy, you're not going to get there overnight. So it takes time. Some of these larger value add deals, it might take 2 years to work through the renovations. So that's something just to take a look at and make sure you're asking those questions when you're looking at investing in deals, is what that timeline is to get up to that stabilized economic occupancy around 90 to 92%.
What's really neat about the underwriting tool that Brandon's an absolute master at is that ability to lay that in there. You're able to show how many units you can bring up, talking more on the renovation side of things, but how long that'll take, how many you can do in a month or in a quarter, and it'll slowly roll them in so that your income doesn't get distorted. So yeah, there are some really neat underwriting tools that can help, that we, and for Brandon, utilize it so that when we do project these, it is conservative and realistic.
Yep. All right. So still in this financial analysis, estimating that GPR, or that gross potential rent, we'll talk a little bit more in depth about it, but this is one of the most important metrics within it. It really drives the income, which really drives the entire business plan, right? So when we're trying to figure out what that gross potential rent could be and should be, we really want to dive in here and spend a lot of time. So we want to look at the unit mix and get detailed about it at this stage. A lot of times you might see in a broker's OM or otherwise an average. There may be a few different unit types: 1 bedrooms, 2 bedrooms, 3 bedrooms, and they may just average those over a square foot basis and then say you can get X dollars per square foot and do it that way. But averages can be very dangerous. So you want to make sure that we're looking at it detailed and know what those breakouts are, so that we can really get an accurate representation of the rent. And along that, you move into that next step here in the rent comp analysis. This is incredibly important, that you're doing a detailed analysis and checking. And when I say you, your sponsors, potentially as an LP, you want to make sure your sponsors are doing these and you can check them on it. But really want to analyze comps for similar properties in that market. And really, these comps should be similar in age. They should be close by, same type, same size property, and same size units, similar amenities, construction, fit and finish. So really, if you're trying to determine what you really think the market rents should be, you need to be comparing apples to apples here. So what we want to make sure is we're not looking at a 1980s property and trying to compete in rents with a 2010 vintage property. Those aren't like for like, or same if they have granite countertops and we're not looking to have granite countertops. We can't really compare those rents or expect to be able to get the same rent. So that's really important to make sure that those comparisons and those comps are comparing apples to apples. We also want to look at what the trends are. This is much more important even today than it has been in the last few years, where the market's really been going up. We really want to understand if those rents are flattening. In some markets, they're actually declining a little bit due to the supply, and we'll talk a bit more. But we want to understand those trends, and we want to make sure that we're forecasting those appropriately. And then really using those rent comps to drive that renovation strategy. If we're doing a value add project where we're, again, looking at like kind properties, we want to see if the property next door that's a similar age, similar size, if they're getting $1,200 a month and they have solid surface countertops, then we don't necessarily want to go in and say we're going to do granite countertops. We're going to want to be at the same as the market to get to that 1,200. And on the other side of that, we don't want to come in and do laminate countertops and think we'll be able to get up to that. So we really want to use those comps to help drive that renovation strategy, so we don't overdo it and go above what the market's asking for, but also don't underdo it on that. So this is a really important step right here.
Yeah, and for early on, it's very important for us too, when we're looking at the OM and they're giving us, comps of the area and comparable rents for properties, that we are actually looking at doing a deep dive into it, because sometimes, not always, but it is fairly frequent for them to throw in a couple properties that aren't quite apples to apples for what we're doing. So it's always good to double check that too.
All right, and then on the expense side, on this end, we'll be reviewing the T12 expenses. So again, that's the prior year. And as Mike mentioned, on the income, we typically look at the T3, the trailing 3 months. And the reason that we look at these differently, generally speaking, is on the income side, you really want to see how that property is performing right now. Maybe the rents were higher 9 months ago and they've been declining, or having to lower rents to get people in. Or they've been having more concessions, or the rent's been going up. So you really want to make sure that you're looking at the last 3 months for the income side to get the best picture. Whereas on the flip side, on the expenses, we like to look at the trailing 12 because those expenses, maybe there's some bigger expenses that only hit once every other quarter. Taxes are frequently that way, where they're not distributed monthly. Or if you're here in the upper Midwest, the winters, your gas bill is going to be quite a bit higher than the summer. So you want to look at that whole 12 months to get a good sense of where those expenses are. Again, generally speaking, we look at the rule of thumb for operating expense ratios to be somewhere between 45 and 55%, with the lower being newer properties, newly renovated properties. There's maybe not as much maintenance and upkeep. Older vintage properties, probably on that higher end of the 55%. But these really do vary greatly from market to market and between classes of property. If it's a Class A, much nicer, probably lower maintenance costs. Class C, again, higher maintenance costs potentially. So make sure that the due diligence is done and don't rely on these rules of thumb. We do have here on the right just some typical ranges that we've seen. But again, don't rely on these. But the big ones that you want to, that really can impact these are insurance and taxes. Certainly the others are very important and should be factored appropriately. But insurance, especially in the last couple of years, has gone up, and this year particular has gone up dramatically. So we don't use any rules of thumb or estimates. It's only quoted insurance for sure on that portion, and multiple quotes. Here even locally in my smaller market in Rapid, I feel like I have a pretty good handle on what the typical expenses are for what we generally look at. And on that property that Mike had mentioned earlier on, our quotes were nearly double what I've been seeing in the last few years. So much higher than we expected. So we don't rely on that at all. Insurance is important to dial in right now. And then taxes, these just vary. One, they've been going up in the past few years, as I'm sure we all know, but they are very local dependent. They vary state, county, city. Make sure that these are being calculated appropriately based on that given area and that property, because these can have a real big impact and can really swing a property one way or the other if they're not calculated appropriately.
Yeah, Brandon and I were recently at a conference, and they talked about how in certain markets that the insurance was now starting to flatten, where for a little while now it had really cranked up. I mean, looking at 40% increases, even more. Wasn't really seeing that here. Now I'm getting letters in the mail, and they just started to come last week. Different agents that we use wanting to meet and discuss the changes in our premium, and they are going up a lot, and wanting to discuss ideas and thoughts. And really the only option there is to increase your deductible if you want to try to keep that premium about the same. But we are starting to see that here. So it is interesting how it kind of comes and goes from market to market. But as a whole across the nation, insurance has been a tough one.
All right, now for the last piece here, the last step, and that's really determining the offer price. We've talked about how these properties are valued in a couple of our prior webinars, but just as a reminder, commercial real estate is valued based on that NOI, or net operating income, just your income minus expenses, again, not including debt, divided by a capitalization rate, a cap rate, which is a percentage. And that's market dependent, and that will drive the value. Typically, that's how these strike or whisper prices are determined by the broker. They will take their pro forma divided by what they see in the market as a cap rate and determine a value. For us, it's very important that we only determine our value based off of what our business plan is, what we truly believe we can achieve from a net operating income standpoint, and what offer price we back into that offer price based on our minimum returns to our investors, not the other way around. So while we do monitor and look at what the market cap rates are at purchase, we don't base our offer prices off of that. It's purely based off of, can we meet those returns based on our business plan? That's the price we're willing to offer. Table on the right here is just some of the more common return targets and really what we look to hit. Generally, we're looking at 70-30 splits, so 70% to the LPs, 30 to the GP. Minimum cash on cash return of 7%, generally with a pref around 7 or 8, and then a minimum 14% IRR. And like to see that the cash on cash is typically around at least half of what the IRR is, which means that we get a good blend of both cash flow and some appreciation, some forced appreciation through good operations. And then a minimum equity multiple of at least 1.75 generally we're really looking to double investor money or get pretty close over a 5-year period is really what we look for. But again, the basis here is we don't base it off of market cap rates and what others are willing to pay. We base it off our business plan and what our return metrics need to be for our investors. Some of the other common deal assumptions that aren't necessarily just in that income and expenses that really play a factor here is closing costs and hold period. So closing costs, just like buying a house, there's closing costs typically between 2 and 4% of purchase price. And then that hold period can really impact. We very often are looking at 5-year holds, at least for what we're assuming. You can see 7 or 10, sometimes maybe shorter, but 5 is pretty typical to see. The big thing is the longer the hold period, it generally influences your IRR negatively, but a longer hold period can improve your cash on cash. We'll talk about that again in a minute. But again, that's based on your investment goals and the strategy for that business plan. The next one that's really critical is operating reserves. This is the rainy day fund, cash that we're going to have in an account ready for if something unexpected happens. And that's different and separate from CapEx reserves, which you'll often see, and those are generally required by the lender. These operating reserves are for the rainy day, we need to be able to pay our expenses for X amount of time. It's a contingency plan. We generally project 3 to 6 months, depending on the property and the location, but it's certainly necessary, and especially in a volatile market like we're seeing right now. These are there really to help soften the blow. And the analogy I use is a shock absorber. Those operating reserves are there for the ups and downs, where we can help level those ups and downs out and make it a little bit smoother. Growth rates are a big assumption in here. Nobody has a crystal ball, but we do like to look at data and try to get a good sense for what those growth rates could be. 3% is considered fairly conservative, but again, right now we're seeing some markets where rents are flattening. So increase in rents may be lower than 3%. Expenses have been going up, so you want to look at what that inflation expectation is. But the biggest thing here is you want to know the why. The number to me is less important than why are we choosing that? Is it just a flat 3% because that's what it's always been, or that's what we've always used, or are the sponsors and the operators really looking at the market and saying, demand, we don't have supply coming. Here's the why that we think we can increase, or we do have supply coming, so we're going to hold it flat for a couple of years before we think that it'll increase. So it's just important to understand the why and ask those questions. Again, that partnership structure, is it 70-30? Is it 80-20? What the pref return is. Again, 70-30 and 7 to 8% is common for us. Cap rates, again, the entry cap, less important, but definitely understanding what the projected exit cap rate is, which really determines that exit value when you refi or sell. That can really drive returns, especially the IRR. Typically, we like to include an escalator. If we think the market is currently at X cap rate, we like to increase it slightly over that hold period, just to make sure if the market softens, that's not what is going to impact our returns. We've got a little bit of a cushion there. And then obviously the debt structure, what loan to value, what interest rates, interest only, those assumptions all have a big impact there.
Yeah, this is always a great opportunity for us to go through this and just double, triple check to make sure that, without having that crystal ball, that we're trying to be conservative. And if we're not, like you said, having that operating reserve to absorb anything that might jump out, like insurances. If with the storms that were had, nobody had thought that was going to happen. And then require for the insurance companies to increase the insurance as a half. But no, it's nice to have that built in.
Yeah, and then how do all these different assumptions and inputs really impact the returns, and which ones have the greatest impact? So a colleague and a good friend, Craig Drummond with Creek Capital, put this together and did some sensitivity analyses, and this really paints a great picture. And I love these graphs. It really helps understand. So we're looking at IRR and cash on cash because they're generally the most common. but really where are the sensitivities? And you can see here that in both IRR and cash on cash, that year one assumed gross potential rent has the biggest impact on both of those. Generally, assumptions around that exit value or residual sale value over time impact your IRR more, whereas the actual operations and the cash flows generally impact your cash on cash more. It's going to vary deal to deal, but this is this is pretty this should be pretty similar across deals. Longer holds, again, they tend to increase your cash on cash and decrease IRR. So that really is dependent on what your investment goals are. If you're looking for that smooth cash flow, longer holds may be okay. If you're looking for a higher IRR and don't care necessarily about consistent distributions throughout it, a shorter hold may be what you're after. But again, really the gross potential rent is one of the most influential factors here. So that's a place, whether you're looking to invest in somebody else's deal or in your own, this really gives you a good place to see where you need to spend the most time to get good return on your time and effort. And that really is making sure you get your rent projections correct.
So what are we seeing in the market, and why are so many deals not penciling? Like we mentioned up front, is we've looked at a lot of deals, and it's been hard to try to even get close, and wondering why can we be off so far. But it's kind of been a shock to everyone, is that, look at the cost of debt. It's nearly doubled in the past several years. So the people that had bought, a few years back at the interest rates that they did, they were not expecting to try to sell in a market like this, where the interest rates have nearly doubled. So that has been hard for them to even fathom, this, and be able to pencil it per se backwards to a list price that might make sense to a potential buyer. And that's why we're seeing a lot of the deals that are coming up are ones that need to sell, because there may be, and we'll talk about it in a coming slide, but because their debt is coming due, and they're going to have to work with the bank to refinance. Expenses are growing, and as we mentioned before, insurance and taxes have been the biggest one, but everything in general, with inflation, wages have gone up, and so with that, when you have higher expenses, that kind of hurts the NOI and your offer price. So that is another one that we see common. And then, there has been a lot of new supply coming online. When we look at construction, to get it from the approval process to the, leasing process, that can take some time. So when we end up, when you see a lot of stuff coming on the market, like right now, they began this process a while back and had the financing in place or getting that set. But, so those units are coming, and they're trying to get those leased up. But we also have, inflation that's hitting all of us, and including tenants. So it hasn't, the rents haven't gone up much more, because if we look back when the supply was low, there's a lot of construction going on, and individuals were able to increase the rents because of the supply and demand, and now that's being caught up. But we'll show you in the next slide how that may change, in the inverse of this too. So
yeah, and just to tie this to kind of what we were talking with, determining our offer price, and why we don't necessarily look too much at that current cap rate. Those cap rates they take time to catch up, like I had mentioned. So at the end of the day, the reason so many deals are not penciling right now is because the market cap rates and sellers are still hoping to get that purchase price, but we're basing it on just those solid fundamentals. So it doesn't matter what the market does. We're still looking at the same fundamentals, whether the market allows it or not. So we're not going to bend too much for the market. We're just sticking to what we know is good business, and we know that the deals will come, and we're only going to take the ones that actually make sense.
Yeah, exactly. But on this slide, we're looking at, let me see if there it is. what are we seeing in the market and the opportunities that are on the horizon? And on the right here on the top is the debt that's going to be maturing in the next few years. And as you can see, from 2024 to 2027, there's going to be $2 trillion worth of debt maturing. So a large slug of that is coming through here in 2024. Some of it's already there, and quite a bit yet to come through the rest of this year. But as that happens, and it's maturing, and they're needing to go back to the bank and refinance these terms, they're not going to be able to hit the debt service coverage ratio that the bank is going to requires. And you take, again, going back to the other slide, the high interest rates, the additional expenses and taxes, insurance, etc. It's putting them underwater for their ability to operate that business. So we foresee a lot of stuff coming up for sale. Not always because they want to, some of it's going to be because they have to. So it's always sad to see that happen, but it is just part of that market cycle that is catching up to it. So we do see that kind of tailing off, as you can see through that graph. But for the next couple of years, there's quite a bit. And then multifamily building permits, there's not nearly as many of them nationwide either. And again, because over the last year, looking at the interest rates, the material costs, labor costs, etc., it's put it in a position where it's not feasible to build new inventory. So that's actually going to put a constraint on the units that are there. Again, it's all market dependent, but there will be a pinch, and we'll be back to not enough units for the number of renters that are needed. Then that kind of turns that cycle back, where we'll end up seeing rents increase again too, again in certain markets. So yeah, that's kind of what we're seeing coming up on the horizon. It'll be interesting how that all plays out over the next number of months and years. But again, like Brandon said, we don't change our criteria. We continue to stick to it, no matter what the market conditions are. And just to make sure that we're buying assets at the right price. Like I said, if you have a chance, please throw your questions in the Q&A. We would love to answer them. I do see that we do have a question. What does fit mean in fit and finish?
Yeah, so when we were talking about looking at the different unit types and what kind of shape they're in. So the fit is really that size and the layout, and seeing if it's we use the term functional obsolescence. Do they have weird layouts that were maybe popular in the 80s? That's the fit size and shape, whereas the finish is just the actual shape. What type of cleanliness, what type of countertops, cabinets, those types of things.
Yep, definitely. And then another is how many deals you end up having to look at, before one can kind of make sense. And that really can vary too. For the longest time, we were looking at deals and not even close, and looking some more, looking at other people's underwriting too, to kind of see on properties that they have found and located, trying to gauge, what their assumptions have been. So it can really vary. I would say it's got to be 100, to be able to submit 3 LOIs. Typically, I think recently has been maybe a little bit more than that. Although this last month has been good. I've pleasantly surprised on that. So we're feeling very confident that we will, that in these next few months, we're going to be excited about some deals, more excited than we have been maybe say 6 months ago, when it just felt like we kept on running into that brick wall. But like I said, there's been a lot of changes in the economy that are showing us, and it's been good. But sad in regards to the expenses and what it's kind of cost for these refinances that need to come up for some people. But it's been good in regards to being able to see the deals that get closer to penciling.
Yep. Yeah, I like to use the term cautiously optimistic. I definitely see opportunity coming. But again, I think we all know the volatility that's been in the economy in general the last year or two or longer. So we really cautiously look at these for sure. And at the end of the day, we look at it as though we're looking at real businesses and look at operating them as such. So again, the market does play into what we look at, but we're looking at what we can do for the long term and not being too speculative.
Yeah, most definitely. Will we be sending out these slides? Yeah, we can definitely provide that. That'll be easy enough to do.
Yep.
And so we can email it out. We will also email out a recording of this. So yeah, and we will also get you out this video again through a YouTube link so that you can watch it again. And again, if you guys have any questions, after this, once you have thought about it and chewed on a little bit, feel free to reach out to Brandon or myself. Our information's here on the screen. We always love chatting real estate, seeing where you're at in your investment career. If you're wanting to be an active investor, we can definitely give you thoughts and ideas there. If you want to be a passive investor, we're more than happy to explain different properties that we are looking at and have been looking at, and kind of our long-term goals in that.
Yep, absolutely. And I mean, for sure, if you have questions and want to go deeper into numbers or the finance analysis, that's not for everybody. But that is my forte. So anybody that does want to talk spreadsheets, I'm happy to talk about that. So like Mike said, please reach out at any time.
Yeah, and that's a great icebreaker for part 2, where we are going to let Brandon absolutely tear into an underwriting and it show us the magic behind that, the peek behind the curtain of how he puts that in there in kind of mild changes of what it can really do to numbers. So we're excited about that one. Give us a few weeks to get that all put together and shot out, but we'll definitely send out some invites for that too. So with that, again, thank you, and we'll be in touch.
Yep. Thanks, everybody. Have a great night.